Now, candidates, the statement of profit or loss, statement of profit or loss of a company is similar to that one of a sole proprietorship, save for a few additional expenses which are unique to companies that we include in the statement of profit or loss. So the preparation is the same. We start with the sales, we deduct the cost of sales, then we get to the expenses. But there are expenses that are unique to companies, and such expenses include unique expenses include, number one, directors' fees. Now, we all know that companies are owned by shareholders who appoint directors to run the business on their behalf. And these directors are paid salaries, fees, and other expenses. Salaries and other expenses. For that service, for managing the company, directors receive what we call directors' fees, salaries, and there could be other expenses that the directors are paid, like the compensation for the board of directors, salaries for executive officers, and any other expenses related to board meetings, travel, and so on. So this is a unique expense to companies, which we don't find it in when preparing their sole proprietorships. The second unique expense is audit fees. Audit fees. Now, limited companies, especially those public limited companies, are required by law to audit their financial statements. The Companies Act requires that the financial statements of companies be audited by independent auditors. Now, auditing is the examination of the financial statements of a company by an independent auditor in order to give an opinion as to whether the financial statements portray a true or fair view. So the shareholders appoint the board of directors to manage the company on their behalf. So these board of directors are required to prepare financial statements. Financial statements are prepared by the board of directors. So these shareholders are required by law to appoint an independent auditor who is not an employee of the company, to examine these financial statements. Then this auditor, after examining these financial statements, gives the shareholders a report as to whether the financial statements are prepared in accordance with the financial reporting standards, or whether the financial statements portray a true and fair view of the state of affairs of the company. So you understand. So the company then has to pay auditors for that service. We are calling audit fees. Now, audit fees, these are costs that are associated with the annual audits to ensure the accuracy of financial statements and compliance with regulations. So this is a unique expense to companies. Sole proprietorships are not required by law to audit their financial statements. So that is the second unique expense. Then we have amortization. Amortization. Now, this is the allocation of the cost of intangible assets over their useful life. Now, for fixed assets, when allocating the cost of fixed assets over the useful life, we call it depreciation. But we have other assets that are not physical, intangible assets. Intangible assets do not depreciate, but they are amortized. Intangible assets like goodwill are amortized. So this is an expense that you will in most cases find it in company accounts. Patents, trademarks, these are intangible assets. And when they lose value, we amortize the assets over their economic life. Another one is debenture interest. Debenture interest, number 4. Now, debentures are long-term loans that companies get when a company issues debentures, because a company can either issue shares or it can issue debentures. When it issues shares, the company pays dividends. Dividends. This is another expense. All right. So long-term loans, they attract what we call interest. So this is an expense that is unique to companies, debenture interest. Long-term loans, debentures. Then we have dividends that are paid to the shareholders. It's also unique to companies. You understand? So the preparation, while the basic structure of an income structure is similar for both sole proprietorships and companies, there are indeed additional expenses that are unique to companies that need to be included in the statement of profit or loss account, which include directors' fees, audit fees, amortization, debenture interest, dividends, and so on. Is that clear? Now let's have an illustration. August 2024. This one required candidates to prepare statement of profit and statement of financial position. So let's analyze, before we do the illustration, the statement of financial position. Statement of financial position. Statement of financial position. Now, the statement of financial position, just like the statement of profit or loss, is prepared in a similar way to the statement of financial position of a sole proprietorship or even a partnership. But we have unique items in a company statement of financial position, like the shareholders' equity. 1. you have the shareholders' equity. Shareholders' equity represents the amount invested by shareholders in the company, and it can be divided into ordinary shares, preference shares, or a combination of both. 2, we have share premium. Share premium. Now, share premium is the excess amount received by the company over the par value of the shares. Share premium. This is not just premium, but share premium. I've defined share premium as the excess amount received by the company over the par value of the shares. So if the company issues shares valued at 100 shillings per value, the par value is the book value, is also known as the nominal value. So share premium would be any amount received in excess of the par value. If the amount received is, instead of receiving 100, the company receives 150, then this excess over the par value is what referring to as the share premium. If the par value is 100, but the company receives 150 shillings, the excess of 50 is the share premium. 3, retained earnings. Retained earnings is yet another unique item that you find in the statement of financial position of a company. Now, retained earnings are accumulated profits that have not been distributed as dividends. You recall when you are doing the partnership, the profit is shared at the end of the accounting period. For the sole proprietor, so that the net profit is added to the capital if it is not withdrawn. For a company, we refer to it as retained earnings. This is the profit that has not been distributed as dividends. As the name suggests, it's been retained. The fourth item is what we call reserves. Reserves. Now, reserves are various funds that are set aside for specific purposes, such as a general reserve. You may have general reserve. General reserve. Okay? You may have revaluation reserve. So there are many types of reserves. General reserves, revaluation reserves, capital redemption reserve, capital redemption, fixed asset replacement reserve, fixed asset replacement reserve, and so on. So reserves are amounts that are set aside from the retained earnings. For example, say in 1 year the company has maybe profit for the year. For the year is say 10 million. That is after deducting all the expenses and paying all the taxes. The profit after tax is say 10 million. The company may decide to pay preference dividends of say 1 million. Pay ordinary dividends of say 1 million. Right? Then what remains, this is say 8 million. The company may decide to set aside some funds to the general reserve, say another 1 million. Capital redemption reserve, this is money that is set aside for buying back shares and so on. Fixed asset replacement reserve, this is a money that the company may set aside in case it may want to replace assets. So it's money that is allocated from the company's retained earnings for a specific purpose. You understand? Reserves. Then we have long-term liabilities. These are unique items that you find in statement of financial position of a company. 5 long-term liabilities like debentures. Long-term liabilities like debentures. All right. Debentures are debt securities issued by the company to raise long-term funds. You may have long-term loans, which are unique to companies. Loans taken from banks or other financial institutions with a maturity period of more than 1 year. You will find intangible assets also. Intangible assets like goodwill, like trademarks, patents. These are assets that are not fixed. Intangible. Copyrights, trademarks, patents, goodwill, and so on.